Something is no longer adding up in the silver market, and the numbers now leave very little room for interpretation. Today is Saturday, 14th of February, and the data sitting in front of us paints a picture that should make anyone paying attention uncomfortable. The largest precious metals exchange in the world, COMEX, the institution responsible for setting the global benchmark price of silver, is operating with registered vault inventories that have collapsed by roughly 70% in just 4 years. At the same time, paper contracts representing approximately 800 million ounces remain open and outstanding. Only about 45 million ounces are currently registered and available for delivery. That means there are roughly 18 paper claims for every single ounce of physical silver that can actually be delivered. And when broader global derivatives are included, some analysts estimate the leverage expands to 356 paper claims for every ounce of real metal in existence. These are not exaggerated statistics. They are structural facts. Now combine that with what happened last week. The paper price of silver plunged 31% in a single trading session, yet physical silver premiums across parts of Asia surged to $20, $30, even $50 above spot. Buyers were paying more than $125 for metal when the official exchange price suggested it was worth closer to $75 at the lows. Those two realities cannot logically coexist for long. Either the paper market is mispricing silver, or the physical market is detached from reason. The widening gap suggests something deeper is unfolding beneath the surface. To understand how we reach this point, we need to examine the internal structure of COMEX vault inventories. The exchange operates through a network of approved vaults, primarily located in the New York region. Inside these vaults, silver is categorized into two groups: registered and eligible. Registered silver is metal that is available for immediate delivery against futures contracts. If a contract holder chooses to stand for delivery, it is the registered category that must fulfill that obligation. Eligible silver, by contrast, is metal stored in the vaults but not committed to delivery. It belongs to private entities using vault services and cannot automatically back futures contracts. That distinction matters enormously because only registered silver provides the actual physical foundation for the massive paper trading volume taking place daily. Back in 2020, COMEX registered silver inventories stood near 150 million ounces. That inventory level created the appearance of depth and resilience within the system. It provided a visible buffer against delivery pressure. Fast forward to today, and registered silver has fallen to roughly 45 million ounces. 70% of deliverable metal has left the registered category. Meanwhile, open interest in silver futures remains near 800 million ounces. That creates an approximate 18-to-1 ratio of paper claims to physical silver available for delivery. Globally, when unallocated accounts and derivative exposures are included, leverage estimates expand dramatically, with some analysts placing the ratio as high as 356-to-1. In practical terms, this resembles a game where hundreds of participants believe they can sit in the same chair when the music stops. For years, this imbalance did not generate visible crisis because most futures contracts were rolled forward rather than converted into physical delivery. Traders treated silver futures primarily as financial instruments, not as mechanisms to obtain metal. The system functioned because participants assumed that others would not demand delivery simultaneously. Confidence acted as invisible collateral. But confidence is fragile when physical behavior begins to contradict paper pricing. The events of last week exposed this contradiction clearly. Silver's paper price collapsed 31% within a single day. Under ordinary circumstances, such a decline would trigger widespread panic, selling pressure, and collapsing premiums. Instead, the physical market responded in the opposite direction. Buyers in Asia moved aggressively to secure metal. Premiums rose to $20 above spot in several regions. In others, they reached $30. Certain retail channels reported premiums exceeding $50 per ounce. When the exchange price dropped near $75, real-world buyers were paying $125 or more for immediate delivery. That represents a premium of roughly 65% over spot. In a fully functioning market, arbitrage would close such a gap quickly. Traders would buy futures contracts at the lower price, stand for delivery, receive the metal, and sell into the higher physical premium environment. The profit opportunity would eliminate the discrepancy, but the gap did not close, it widened. That widening implies delivery constraints. When holders attempt to convert paper claims into physical silver, the registered inventory may not be sufficient to satisfy broad demand. This brings us to the concept of a COMEX default. A default does not require dramatic collapse or headlines declaring systemic failure. It would occur if the exchange becomes unable to meet delivery obligations in physical metal and instead forces settlement in cash. A version of this nearly unfolded in March 2020 during the early pandemic panic. Physical gold premiums surged above futures pricing by over $100 per ounce. Emergency measures were introduced. Delivery rules were modified to allow 400-ounce London bars to settle obligations. The exchange stabilized the immediate crisis, but the structural leverage remained in place. Since then, registered silver inventories have declined sharply, industrial demand has accelerated, and paper exposure remains elevated. The conditions today differ materially from those in 2020. Registered inventories are approximately 70% lower. The paper-to-physical leverage ratio has widened. Industrial demand from solar panels, artificial intelligence infrastructure, electric vehicles, and military applications has expanded. Silver is increasingly essential to technologies that cannot operate without its conductivity and reflectivity. At the same time, China has restricted silver exports, limiting authorized exporters to just 44 companies nationwide. Smaller refiners that previously supplied global markets face constraints. The United States government has formally designated silver as a critical mineral and initiated stockpiling measures estimated at around $12 billion. That means governments themselves are now competing for physical supply. When declining inventories, rising industrial demand, export restrictions, and government accumulation converge with an 18-to-1 leverage ratio, the margin for error narrows. The divergence between paper pricing and physical premiums is not random volatility, it is a stress signal. One market trades leveraged contracts in massive volume. The other trades scarce metal that must be physically delivered. As long as those two markets align, pricing appears stable. When they diverge this dramatically, pressure builds. Right now, the paper market implies silver is worth roughly $82. Physical buyers in certain regions are signaling a value between $100 and $130 depending on availability and form. That difference cannot remain indefinitely. Either futures prices rise to reflect tightening physical conditions, or the credibility of the paper pricing mechanism deteriorates, and credibility is the foundation of the entire future structure. Once confidence in deliverability weakens, the pricing mechanism itself becomes vulnerable. The numbers we are examining are not abstract statistics. They represent strain accumulating beneath the surface of the global silver market. To understand where this tension could lead, we have to examine how silver is actually priced in the modern financial system. Most investors believe the silver price reflects a global equilibrium of supply and demand. In reality, the number displayed on financial platforms is primarily derived from futures contracts traded on COMEX. The spot price originates from leveraged paper transactions, not from direct physical exchanges of bars and coins. As long as market participants believe that a futures contract can reliably be converted into physical metal, this system functions smoothly. But if confidence in that convertibility begins to weaken, the entire foundation of price discovery starts to shift. The futures price only maintains authority because participants trust that it represents something tangible. Once that trust erodes, pricing power can migrate toward the physical market rapidly. We have historical precedent for structural stress inside the silver market. In 1980, the Hunt brothers accumulated an estimated 200 million ounces of physical silver, representing roughly one-third of the global supply at the time. As they expanded their holdings, the price of silver surged from approximately $6 to nearly $50 per ounce within months. The exchange responded decisively. Margin requirements were raised to extraordinary levels. Position limits were tightened. Trading rules were adjusted to liquidation only, meaning investors could sell contracts but were restricted from initiating new long positions. These interventions forced prices downward and ultimately ended the rally. The dominant narrative suggests the Hunts attempted to manipulate the market and failed. Another interpretation is that their accumulation exposed the vulnerability of a highly leveraged paper system backed by limited physical supply. When stress intensified, the rules changed to preserve stability. Now consider the present situation. Margin requirements were increased sharply just before the recent 31% crash. The timing may not prove intention, but it demonstrates sensitivity within the exchange whenever volatility accelerates. The key difference between 1980 and today lies in the source of demand. The Hunts were two wealthy individuals attempting to corner a market. Today, buying pressure is diversified and global. China continues accumulating precious metals as part of long-term reserve diversification strategies. India's retail market historically increases purchases during price weakness. Central banks worldwide are gradually reducing exposure to dollar-based assets. Solar manufacturers require large quantities of silver for photovoltaic production. Artificial intelligence infrastructure depends on advanced electrical systems that rely on silver's conductivity. Electric vehicle manufacturing consumes increasing volumes annually. Defense contractors integrate silver into electronics, guidance systems, and specialized military applications. Demand is not concentrated in one pair of hands. It is distributed across industries and governments. Supply conditions, meanwhile, have not expanded proportionally. Silver has experienced 6 consecutive years of structural deficit. Since 2019, global consumption has exceeded new mine production by approximately 800 million ounces. Above-ground inventories have gradually filled that gap, but they are not infinite. Unlike gold, silver does not have extensive central bank reserves waiting to be mobilized. The United States government liquidated most of its strategic silver stockpile decades ago. Much of the silver consumed by industry is not economically recoverable. Once embedded in solar panels or complex electronics, it effectively exits the supply chain. Every year of deficit erodes available inventory further. This steady depletion quietly reduces the buffer supporting the futures system. When persistent deficits intersect with shrinking registered inventories and elevated leverage ratios, fragility increases. The exchange relies on the assumption that only a small fraction of futures contracts will ever demand physical delivery. If that assumption holds, an 18-to-1 ratio can persist, but if behavior shifts and more participants stand for delivery simultaneously, the registered category could be exhausted quickly. Shorts would then face difficult decisions. They could attempt to source metal in the open market to meet obligations, but in a tightening supply environment, that buying would likely push prices sharply higher. Alternatively, they could rely on regulatory intervention to limit delivery pressure. Either path introduces instability. Consider the implications of forced cash settlement. If COMEX were unable to deliver sufficient metal and instead settled contracts financially, the immediate crisis might be contained. However, the psychological impact would be profound. Futures contracts exist to provide certainty of price for hedgers and certainty of delivery for buyers. If delivery certainty disappears, confidence declines. Market participants would increasingly favor allocated storage and direct ownership over paper exposure. Premiums in the physical market could widen further. The divergence between futures pricing and physical transactions might become structural rather than temporary. Recent behavior suggests early signs of this shift. During the 31% paper decline, physical demand accelerated instead of retreating. Dealers in Asia reported elevated order flow. The Perth Mint described unprecedented buying interest. Indian markets adjusted quickly in local currency terms despite global futures weakness. Rather than interpreting paper weakness as evidence of declining value, physical buyers treated it as an opportunity to secure scarce metal. That behavioral divergence matters. Markets change when participants change their assumptions. Regulatory flexibility also plays a central role. Exchanges possess authority to adjust margin requirements, implement position limits, and modify settlement procedures during periods of stress. These tools can delay systemic strain by discouraging delivery and encouraging liquidation. But each intervention carries reputational consequences. If rule changes appear reactive to structural shortages rather than neutral risk management, trust erodes incrementally. Futures markets depend on consistent, predictable enforcement. Perceived inconsistency can accelerate migration toward alternative pricing mechanisms. It is essential to recognize that none of these dynamics guarantee immediate collapse. Large financial institutions have substantial resources and influence. They can extend timelines and introduce temporary stabilizers. However, arithmetic remains constant. 45 million ounces of registered silver cannot indefinitely support 800 million ounces of open interest if delivery behavior changes materially. Leverage that appears manageable during complacency can become destabilizing during stress. The trajectory of inventory decline and industrial expansion suggests that tension is building rather than dissipating. Right now, the silver market operates in parallel dimensions. One dimension consists of highly leveraged paper contracts traded in enormous volume. The other dimension consists of physical bars and coins exchanged at premiums reflecting real-world scarcity. As long as those dimensions move in relative harmony, pricing appears coherent. When they separate sharply, instability emerges. The 31% crash paired with $50 physical premiums is not random noise. It is a signal that paper pricing and physical valuation are no longer aligned. Whether that misalignment resolves through orderly repricing or structural disruption remains uncertain. But history shows that prolonged divergence between abstraction and tangible supply eventually forces convergence. And convergence, when it arrives, is rarely subtle. Now we bring this back to the core issue. The question is not whether silver will remain volatile. The question is whether the current structure of the silver market can continue functioning under these conditions without a significant adjustment. The numbers are not ambiguous. Approximately 45 million ounces of registered silver remain available for delivery on COMEX. Open interest represents roughly 800 million ounces of paper claims. Globally, derivative exposure expands leverage estimates as high as 356 to 1. Silver has recorded 6 consecutive years of structural supply deficits, totaling around 800 million ounces since 2019. China has restricted exports to just 44 authorized companies. The United States has designated silver a critical mineral and initiated a $12 billion stockpiling effort. Meanwhile, physical premiums surged to $20, $30, and even $50 above spot during a week when the paper price fell 31% in a single day. These data points are not speculative. They are structural indicators of tension. Skeptics argue that futures markets have always operated on fractional backing. They emphasize that only a small percentage of contracts result in delivery. They suggest that the exchange can continue functioning indefinitely as long as most participants roll positions forward rather than demanding metal. That reasoning is not irrational. Fractional systems depend on behavior remaining predictable. But the stability of any fractional structure ultimately rests on confidence. If a growing number of participants begin to question whether their claims can be converted into physical metal, behavior changes. Once behavior shifts, leverage ratios that once appeared manageable can become destabilizing rapidly. Imagine a scenario where a larger than usual percentage of contract holders decide simultaneously to stand for delivery. It would not require the entire 800 million ounces to be claimed. Even a modest increase in delivery requests could place substantial strain on the 45 million ounce registered inventory. Shorts would be required to deliver metal or source it in the open market. In an environment already characterized by deficits and export restrictions, sourcing large volumes quickly would likely push prices sharply higher. If the exchange intervened and forced cash settlement instead of physical delivery, the immediate shortage might be concealed, but the long-term impact on credibility would be significant. Participants would recognize that futures contracts no longer guarantee metal access. The purpose of a futures contract is certainty. Producers hedge output, manufacturers hedge input costs, investors seek liquidity and price exposure. If certainty of delivery disappears, participants adjust their strategies. Allocated storage and direct ownership become more attractive relative to paper instruments. Once pricing authority migrates away from centralized futures exchanges toward decentralized physical transactions, volatility can increase dramatically. Futures prices may continue to print on screens, but their influence over real-world transactions could weaken. Recent events suggest that this transition may already be underway in subtle form. During the 31% paper decline, physical buyers did not retreat. They accelerated purchases at elevated premiums. Dealers across Asia reported strong demand. The Perth Mint described unprecedented buying activity. Indian markets adjusted quickly in rupee terms. Instead of interpreting the crash as evidence that silver was less valuable, physical participants treated it as an opportunity to secure scarce supply. That behavioral divergence matters. Markets evolve when participant psychology evolves. Industrial consumption reinforces this pressure. Silver's properties make it essential in solar panels, electronics, artificial intelligence infrastructure, electric vehicles, and advanced defense systems. Much of this usage is not economically recoverable. Once silver is embedded in industrial applications, it effectively exits the supply chain. 6 consecutive years of deficit have already reduced available above-ground inventory. Each additional year of consumption without sufficient replacement further tightens supply. Unlike gold, which accumulates in vaults and jewelry, silver is continuously consumed. The leverage ratio illustrates the underlying vulnerability. 18 paper ounces per registered ounce on COMEX is sustainable only if delivery demand remains minimal. Expand the perspective globally to 356 to 1, and the system resembles a structure built primarily on assumption rather than physical backing. For years, that assumption held because participants trusted that others would not demand simultaneous redemption. But trust can erode quietly. Widening physical premiums during paper weakness introduced doubt. Doubt spreads through financial systems faster than physical shortages. Government policy adds another layer. When the United States labels silver a critical mineral and commits billions towards stockpiling, it signals strategic importance. When China restricts exports to a limited group of authorized companies, it signals tighter control over supply. These measures reflect recognition that silver plays an increasingly central role in technological infrastructure and national competitiveness. When governments compete with private buyers for the same metal, scarcity intensifies. None of this guarantees immediate collapse. Exchanges possess regulatory tools to manage stress. They can raise margins, adjust position limits, and modify settlement procedures. They can encourage rollovers and discourage delivery. They can extend stability for longer than many expect. But regulatory flexibility does not eliminate arithmetic. 45 million ounces cannot indefinitely support 800 million ounces of open interest if delivery demand changes meaningfully. Persistent deficits cannot continue forever without eventual repricing. Premiums of $50 above spot are not minor distortions. They are signals that physical markets perceive scarcity. If paper prices rise to reconcile with physical demand, the adjustment could be substantial and rapid. If paper markets fracture under delivery strain, pricing authority could shift toward physical hubs outside traditional exchanges. In either case, the present divergence represents imbalance, not equilibrium. The silver market today is stretched between leverage and scarcity. When that stretch reaches its structural limit, resolution follows. For individuals, the distinction between paper exposure and physical ownership becomes increasingly relevant. Paper instruments offer liquidity and convenience, but depend on counterparties and clearing mechanisms. Physical silver represents direct possession without intermediary risk. During calm periods, that difference appears theoretical. During structural stress, it becomes practical. The 70% decline in registered inventories since 2020, the 31% paper crash paired with $50 physical premiums, the 18-to-1 COMEX ratio, the 356-to-1 global derivative leverage, the 6-year supply deficit totaling 800 million ounces, the export restrictions in China, the critical mineral designation in the United States, the $12 billion stockpile initiative, and accelerating industrial consumption all point in the same direction. The silver market is under measurable strain. Whether that strain resolves through gradual repricing or abrupt disruption remains uncertain, but prolonged divergence between paper abstraction and physical reality rarely persists indefinitely. Convergence eventually occurs. The only remaining uncertainty is timing.